Welcome back to the channel, everyone, and in this video we're going to find out what are your chances of being audited by the IRS. So like I said, in this video, we're going to be covering what your chances are of being audited by the IRS. Now, before we get started, I just want to mention I'm an entrepreneur. I've been filing my taxes myself with the help of a CPA for a few years now, so I know a little bit about this information, but obviously I am not a certified accountant or CPA, so definitely talk to one of those people before you're going to be filing your own taxes. But we're going to get into all this information, what your chances are, and three things that determine your chances are going to be your income level, how much money you're making, the activities on your tax return. If you're just working for a business and you're not doing anything on the side, you don't have any investments or anything like that, chances are you're probably not going to be audited if you're not trying to do anything fishy. And then the last one is going to be unusual items on your tax return. So if you're only making like 50 grand a year, you have like $20,000 in charity donations, that's a little fishy to someone who's only making about 50 grand. So that might get you flagged for the IRS and potentially get audited. So we'll go over all of that, and we'll go over what your chances are based on your income level. So all this information I'm going to be talking about is from the actual IRS website. I'll have a link so you can check that out yourself. But the IRS says that last year, 150 million individual tax returns were filed in the U.S. Now, obviously, there's more people than that in the U.S., but some of them are children. They don't have to file. Some people just decide not to file their taxes, which everyone should. And then there are people who are married, so they file jointly. So obviously, it's not going to be the entire country that's filing. Only 150 million individual tax returns were filed last year. Now, of those 150 million tax returns filed, only 900,000 of them were audited. That is 0.6%. That's less than 1% of all tax returns were audited. So I know what you're thinking, oh, that's not a lot. I don't make a ton of money. Clearly, I don't need to focus on this video. You do, because potentially you can increase your chance of being audited if you're making some mistakes. There's some red flags. If you put them on your tax returns, it greatly increases the chance that you could be in that 0.6%. And one thing I want to mention is that generally the IRS will go after people who make more money. And the reason for that is because the IRS is not very well funded. They don't have a lot of people working there, and they want to spend more resources on going after people that they potentially can get more money from. So let's use an example. Two people, one guy's making $50,000 a year, and potentially he screwed something up on his tax return or lied. And then there's another guy who's making $5 million a year, same situation. He lied or screwed something up on his tax return. Generally speaking, the IRS is going to focus on the $5 million a year guy because potentially, they could look into it and get an extra, 50, 100, or maybe even $500,000 from that guy making $5 million, as opposed to the guy making $50,000. If they look into it, potentially they can get an extra, $1,000 from that guy. That's not really worth their time to go after that guy. In a perfect world, they would go after everyone equally, but they don't. It's not a perfect world, and there's just not enough people working for the IRS to do that. So generally, the higher up income, you have a greater chance of being audited. But again, there are red flags. If you screw this up, you will greatly increase your chance, even if you're making very little money. But let's go over let's break down the different income levels that you have a chance of being audited at. So first up, if you make under $500,000, under $500,000, you have a 0.5% chance of being audited on average. So people less than 500,000, less than 1%. If you make $500,000 to 1 million, you have a 1% chance of being audited. So under 500,000, 0.5, 500,000 to 1 million, it's 1%. If you make $1 to $5 million, $1 to $5 million, you have a 2.2% chance of being audited. If you make $5 to $10 million a year, you have a 4.2% chance of being audited. And if you make over $10 million a year, you have a 6.7% chance of being audited. Now, obviously, those are just averages for those different income levels. Like I said, there are red flags that if you do these things will greatly increase your chance of being audited, and we're going to go over what those are. So for an example, one example is if you get a Schedule C filing your tax returns. If you don't know what a Schedule C is, if you just, you're working for a company, that's all you're doing, you won't get a Schedule C. But potentially if you're doing something where you're an independent contractor, for example, like anyone who works for Uber, who drives for Uber, or Postmates, or any of those type of side gigs or whatever, those are independent contractors. all of those people will get a Schedule C. Also, if you're like a sole proprietor. Now, if you have an LLC that owns a business, you'll file something different. But if you're running your business as a sole proprietor, you will have a Schedule C as well. And having a Schedule C, filing that, will greatly increase your chances of being audited. Now, there's nothing wrong with having a Schedule C. It's just that the IRS chooses to look at the Schedule Cs more closely because potentially people can screw those up a lot easier than just filing a tax return from the business that you work for. Usually people don't screw those up very much, so they do take a closer look if you do have a Schedule C. Another example is if you have losses on your tax returns. So if you have capital losses, losses from investments, or rental properties, potentially that will get you audited, but it's also based on the size of your loss. So if you're filing a tax return, let's say you lost, I don't know, about $10,000 in the stock market or whatever. You sold your stocks, which, you know, if you didn't sell the stocks, you wouldn't have a loss, but you sold them at a loss or whatever, and you lost like $10,000. That's a lot of money. The IRS is going to look more closely at your tax return and see why you lost $10,000. Now again, based on the size, it's going to differ. If you only have a small loss, maybe you had a business, like a part-time business, and you lost like $1,000, it just, you know, it went under. That's really not that big a deal to an IRS, but if you're doing like $50,000, $60,000, $70,000 worth of losses a year, the IRS is going to take a very close look at why you're losing so much money. So that's something that could get you flagged as well. And then another example would be high expenses in comparison to your income. So for example, let's say you make $50,000 a year. Let's say you're a salesman for a company and you travel all over. I live in the state of California. So let's say I travel all over the state of California and I'm trying to sell medical supplies to different hospitals. So I travel all over the state and I make about $50,000 a year. And I'm saying that I had about $30,000 of expenses, you know, based on gas, based on food, all of this cost that's associated with my business and traveling all over. That's going to look really fishy. Why would I have so much in expenses? Now, obviously, you're going to have some expenses for travel, but if your expenses are incredibly high compared to how much money you're making, that's going to look really fishy to the IRS. Another thing, let's say you make $100,000 and you decide to donate $50,000 of that to charity. Now, maybe that's true, maybe you're lying. It doesn't really matter. Again, that's going to look incredibly fishy to the IRS why you're donating half your money to charity. Maybe you're just a really charitable person, but that doesn't happen very often, so they will take a closer look at that. Now, if you had $100,000 you were making a year and you donated $10,000 to a charity a year, that doesn't really look as fishy because it's just a smaller portion of your actual income. Now, one thing that I do want to mention is that when you initially file your tax return, it initially just goes through an electronic system. No one is actually looking at your tax return to start because there are 150 million tax returns being filed each year, and the IRS just doesn't have the manpower to manually look at all of these tax returns, so most of them just go through an electronic system. It scans the tax return, and if it sees anything that it thinks is fishy, maybe you have way too high expenses, maybe you're just trying to hide something, whatever it is, if it sees something that it thinks is fishy, it will flag it and send it for manual review, and then potentially you're in big trouble. So as long as you're not doing something out of the ordinary or you're just trying to be fishy in general, most tax returns will never actually be seen by an actual human being. So keep that in mind. Now, one thing I do want to talk about last is probably the number one reason why you could potentially be audited. People think they're smart when they're doing this. They're not smart. Definitely don't do this. But let's say, for example, I talk about Amazon on this channel from time to time. Let's say you have a business on Amazon selling products. You didn't really make a lot of money. Let's say you made about $5,000 selling products on Amazon this past year. Now, let's say you have an actual business, an actual company that you work for, and you make about $50,000 a year from that company. So you decide you're going to hide that $5,000 you made from Amazon because you have this $50,000 that you can send to the IRS and they'll be like, oh, this is your actual income. And you can just hide that little side income you made. You definitely don't want to do that because any one of these businesses that you're making money from, whether it's Amazon, whether you're doing Uber on the side, you made a couple grand driving for Uber, all of these companies have to send the information of what they paid you to the IRS. So the IRS already has a copy of what you made from Amazon, what you made from Uber or Postmates or any of these side businesses that you're doing. So if you try to hide that information, the IRS will know. They will know that you're hiding the information, and that's probably the number one reason that people get audited, because the IRS, you can't hide anything from the IRS. There's two things you can't avoid in life. It's death and taxes. You're gonna have to pay all your taxes, so if you try and hide it, the IRS will know about it. Now, to end the video, I thought I'd end on a high note. So one thing I do want to mention, because the IRS is so underfunded, the audit rate has actually gone down significantly over the past 10 years or so. So you can be happy in knowing the IRS just doesn't have the manpower, so they just can't afford to audit most people. So that's something, hopefully, to end this video on a good note. But like I mentioned, always pay your taxes. Don't try and hide anything. The IRS knows how much money you're making, so if you do something fishy, they will find out about it. I hope you enjoyed this video. If you did, everyone, be sure and subscribe, like, and leave a comment below. It does help the algorithm if you leave a comment. So thanks for watching, everyone, and have a fantastic day.